Do not
Well, but
own bonds, people. Do not own bonds. Own Bitcoin.
hey, Greg, thank you. You're too kind. The opportunity presented itself, so we took it. But I will make this comment for people listening. Sometimes they wonder why someone would do this. The truth is it's totally rational and it's a benefit to every single person on every side of this trade. For example, the people that bought those bonds, they didn't have the option. If you bought the equity in MicroStrategy, you didn't have the option to buy Bitcoin. You could only buy the equity. If you bought the bonds, the convert bonds, you didn't have the option to buy the equity unless it was a convert, and you didn't have the option to buy Bitcoin. They had pools of capital, billions of dollars worth. And so the people that bought, sometimes, the Bitcoin maxis, they're like, why would you ever buy the security? Well, I mean, the answer is Bitcoin's up 357% year over year. We're up 346% year over year. Maybe you do better with Bitcoin, but if you had $10 billion and you couldn't buy Bitcoin, but you could buy an equity, then you were basically getting 346%, and that compares to it compares to the S&P, right? And if we look at the S&P in the last 12 months, you're 35%, right? So the people that are buying the equity are choosing a Bitcoin equity instead of a non-Bitcoin linked equity. The ones that bought the first convert struck at 398. That was the best performing convertible bond in the entire year, Greg. Like, that was the single best performing bond sold in the entire year. And so the guys that bought the bond, they were pretty smart. They bought the best bond of the year. They made a fortune. Then there's a second bond. You're like, well, why would you buy that? Well, because I can't buy equity and I can't buy Bitcoin and I can get Bitcoin exposure. And then for the junk bond, you could say, oh, I would never loan money at 6 and an eighth. Well, their business is to loan money at 4 and an eighth. And if you're loaning money to Apple Computer, you're loaning it to them at 2 and an eighth. And so Bitcoin fixes everything. And if you inject Bitcoin into junk bonds, you put 100, 200 basis point boost on it. And if you inject it into equity, you put a boost on that. And you really just got to always look at the alternative that the investor had. They don't have the alternative to go with the pure play. Why don't we talk about macroeconomic results for the past 12 months? This is it. We're already on the subject. Bitcoin's
Beautiful.
up 357%. Gold is down 7.26%. S&P is up 35%. Nasdaq's up 42%, and long-dated sovereign debt is down 8%. What's your takeaway?
Well, I'm a bond guy, so my takeaway is sovereign debt is for fools, and it's proving that, because sovereign debt is only a contract. And most of these monkeys have managed debt since my time when I started, when 10-year U.S. Treasury rates were double digits, 14%. But what is a bond? It's only a contract to receive a coupon over a period of time. If you held that original 14% bond through the 10 years, that's what your return would have been, 14% annualized. But everyone thinks they're a trading guru. And what they do after 2 years is they trade in their 14% coupon for the going market coupon, which is 10%, and they crystallize a capital gain on their bond because the price of the bond, the 14 coupon bond, is trading at a substantial premium, and they feel like a hero. But the problem is when interest rates go to zero and then back up to 1.5% in the U.S. Treasury 10-year, guess what the return on the U.S. Treasury 10-year is going to be with 100% certain, not including a potential default. Let's assume the default probability is so low that it is 100% certainty. Your return on the U.S. Treasury over the next 10 years with 100% certainty is going to be 1.58%, where it ended the date after Chairman Powell's announcement.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information, and it helps us spread that message. Sharing is caring. And now, let's continue.
Listen, guys, it's only math. It's a mathematical contract. Also, Michael, it's written in fiat. So you borrow $100 today, or you lend $100. When you get your $100 back in 10 years, the purchasing power of that $100 has been debased by what, 35% easily? So you've made 1.5% over 10 years. and you get 65 cents of value on the dollar you lent at time zero. Bonds are the worst risk return asset class I've ever seen in my 30 years of managing risk. Anybody who owns bonds doesn't understand duration and convexity, or the first derivative and second derivative of bond pricing. It's really a shame. And yet every financial advisor out there in the world is telling the parents of people on this call, you have to own bonds because they are low risk. That's absolutely false and horrible advice. Bonds are an incredibly risky investment right now. The chances of you making an appropriate return on investment in bonds on a real basis, that is after subtracting the costs of inflation, is very, very low. You are taking huge risk for very low potential return. And that's why bond math matters. So macroeconomically, does it surprise me that long-term sovereign debt returned minus 8%? I'll just ask you, what do you think it would have returned if the global central banks weren't in the market suppressing the true rise in interest rates, which would have turned that loss into something easily in the 20% range? So let's run through a quick bond math for you. If the 30-year treasury moves from today's approximate 2% rate, if it goes to 3%, how much does the bond price move on the 30-year treasury? It moves about 20 points down. 20 points, people. This is a real risk that every insurance company in the world is carrying on their balance as long-term assets balanced against their long-term liabilities. It's idiotic. It is absolutely conflicted advice, and yet everyone says you need to own bonds for capital preservation. No, you actually need to own Bitcoin for capital preservation and capital appreciation, and you need to fund it by issuing debt. Again, you can be a borrower or a lender. You're supposed to be a borrower at these rates. Anyone who's lending money at these rates is absolutely failed in risk analysis.
For context, can you elaborate on what these rates were, 10, 15, maybe 20 years ago, just so that everybody can kind of anchor appropriately?
Yeah, so I started in 1988 trading bonds, and U.S. Treasury 10 years were 14%. That's 1985. When I got involved in 1988, they were, when I started trading for institutional money, that was my first job at Royal Bank of Canada, that they were double digits still. But when interest rates go down, bond prices go up. And interest rates have gone from 12% down to next to zero. You flip that on its ear, when interest rates go from 1% up to 5%, bond prices get carved. You lose money. Now, if you don't sell them and it matures, all you've done is earned your coupon, which I'm trying to point out is a very poor return.
So I agree with you. And I think the interesting-ish observation is there are large pools of capital that are locked into investing in obsolete asset classes, right? So gold used to be a store of value, and it isn't anymore. But there's still trillions of dollars locked up in gold, and gold's returned minus 2 basis points a year for a decade. So you gotta think there's just an institutional bias there. And with regard to bonds, I can't understand why you would be long bonds, but there's big institutional lock-in, right? There are trillions of dollars of money that's locked in that can only invest in bonds. So if you're going to invest in bonds, I would say you should invest in Bitcoin-backed bonds that yield higher yields with lower risk.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.